All right, guys. Darius is back, and I thought a great place to start is there's massive chaos and uncertainty in financial markets. There's this carry trade going on in Japan. Everyone seems to think Japan is blowing up, which means the rest of the world is going to follow suit. What's going on, and why are so many people worried about Japan right now?
Hey, absolutely, man. Well, thank you for having me. First and foremost, it's great to be back. It's great to be back as a dad, joining you in the fraternity. So we'll start with chart one, where we just show the policy rates for the Fed, the ECB, the Bank of England, the Bank of Japan, and the Swiss National Bank. And then we show what their respective money markets are pricing in with respect to either rate cuts or rate hikes over various durations. And what we see in Japan, the reason why we're hearing about this unwind of the JPY carry trade, of the yen carry trade, is because many financial institutions globally have funded their levered positions in the JPY market because, as you can see in the chart, Japanese yields have been significantly lower than the rest of the world's major central bank yields. And so it's been a lot easier to finance yourself in JPY, convert that to USD or to euros or wherever else you need in terms of the investments that you're actually trying to make. And we're starting to see a little bit of an unwind of that.
Now, we saw that the Bank of Japan came out and they started talking about what they're going to do on the monetary policy side. We also see some things in kind of the US dollar markets that is telling us what they believe the Fed should be doing. So how do you think about the recent, BOJ comments, but also kind of what the market's telling the Fed to do?
Well, the recent BOJ comments were very supportive for asset markets, and rightfully so. The Bank of Japan essentially came out and said, okay, we get it. We're going to back off. We don't want to. It wasn't our intention to create this kind of volatility with respect to their own policy normalization drive, which is hiking interest rates in Japan, versus our policy normalization drive, which are lowering interest rates in the U.S. And if you look at U.S. dollar money markets relative to what the Fed is sort of last guided to with respect to its dot plot, U.S. dollar rates markets are very much out in front of the Fed, which meaning the Fed is behind the curve with respect to the amount of policy rate easing that we're likely to see between now and December 2025. We're somewhere around 100 basis points priced into U.S. dollar money markets of rate cuts priced in through year in 2024. And then I want to say another, let's call it 125 basis points from there. And so, when you get to, the year in 2025, the market is essentially 100 to 125 basis points priced in more cuts than the Fed. It's effectively begging the Fed to stop hurrying up and waiting and start cutting so that it can preserve the U.S. business cycle.
Now, if we were talking about this in 2021, interest rates were at zero. That'd be a big, big problem. We'd be going negative for sure. But the Fed, maybe the only thing they got right so far, or maybe kind of a blessing in disguise, is they have raised interest rates at a very aggressive pace, and so they have, call it 5.5% or so of interest rates to cut if they want to. You've got some analysis as to what they normally do in these easing cycles and how much they cut. What did your kind of conclusion from that analysis end up being?
Yeah, so going back to great question. Going back to last Friday, in our opinion, the reason we saw an acceleration in the unwind of the yen carry trade and the spike in volatility that obviously Fed bled over into Monday is because the rest of the world investors got very concerned about the prospect of a U.S. recession. Recall that the Somme rule was triggered in the July jobs report, and so investors got very spooked in terms of the likelihood that we would see an accelerated policy rate cutting cycle, monetary easing cycle out of the Fed, which historically has been about 400 basis points in a recession. And recessions caused by tight monetary policy, the Fed has cut rates by 475 basis points on a median level. And so that extra 200 basis points of rate cuts relative to what's already been priced into the forward rate curve got investors very spooked about the speed of the unwind of the yen carry trade. If we're going to take rates, U.S. dollar rates down 200 basis points more than what was already priced in, you're talking about a dollar that's going to get absolutely smoked, and a yen that's going to rally sharply and cause a lot of those carry trades to unwind in a more forceful manner.
Now, the Treasury bond market also, I think, is kind of trading in this lockstep. What exactly is happening here?
Yeah, absolutely. So we can see this chart just shows the December 2024 Fed funds rate yield minus the current Fed funds rate, shows the 25 yield, and then our OIS derived Fed funds rate. And we can see that both the bond market, as evidenced by the 10-year yield, and the currency market, the US dollar, are moving in lockstep with the market implied path of the policy rate. And so it's actually it's helpful to know that this is the Federal Reserve that's being cajoled by financial markets to understand that to get rates lower here in a more expeditious manner.
Now, these central banks don't act in a vacuum. Obviously, people in the United States pay attention to the Federal Reserve. There's people in other countries that pay attention to their local central bank. But you can compare the relative decisions, right? If the Fed does something and maybe the ECB doesn't, et cetera. What is the market telling us in terms of what the Fed's going to do compared to everyone else around the world?
Yeah, that's a great question. So in this next chart, we just show what the markets are pricing in for a policy rate easing relative over the next year for each of the Fed, the ECB, the Bank of England, the Bank of Japan, and the Swiss National Bank. And we also show that relative to the Taylor rule spreads. So what we did in this chart, where we take the 12-month bill yield for those respective economies, and then we subtract the baseline Taylor rule estimate for those central banks, which is an estimation, which is a modeled implied policy rate estimate based on John Taylor's famous formula. And so what we see is that the Federal Reserve, relative to its Taylor rule implied policy rate, is much tighter than all the rest of the world's central banks. It's only the current Fed funds rate is only 74 basis points lower than the implied Taylor rule estimate, not the Fed funds rate, rather the 12-month T-bill yield. We're using 12-month bill yields to actually contribute the influence of forward guidance into the analysis. And that minus 74 basis points compares to minus 439 basis points currently for the ECB, minus 322 basis points for the Bank of England, minus 441 basis points for the Bank of Japan, and minus 279 basis points for the Swiss National Bank. So the market is saying that the Fed is by far the most tight central bank right now. And as a function of that, when you look at current money market pricing, the market is saying the Fed is going to cut rates much faster than these peer central banks over the next year. And so right now, the overnight index swap market are pricing in 215 basis points of rate cuts by the Fed over the next year. That compares favorably to only 145 basis points of rate cuts by the ECB, only 129 basis points of rate cuts by the Bank of England, plus 17 basis points of rate hikes by the Bank of Japan, and minus 63 basis points of rate cuts by the Swiss National Bank. So if that actually occurs, if that's in the area code of correct, then we're going to see a downtrend in the U.S. dollar over the next 12 months as markets reprice, as some of these carry trades kind of reprice, and the mismatch between dollar funding, yen funding, et cetera, starts to kind of unwind a bit, and perhaps in a more less deleterious manner.
Now, what's interesting about this is this weaker U.S. dollar has some implications. You've got two implications here, one with the PBOC, but also a kind of cross-border trade. And so explain how you see a weaker U.S. dollar playing out.
Yeah, so one of the things that we've been pounding the table on here is that the U.S. economy has been resilient. We've been talking about that here on this program for literally 2 years now. And so having authored that being back in the summer of 2022. And what we're trying to explain to investors is if we get a sustained downtrend in the U.S. dollar that is not moving with the speed that we've observed over the past few days, i.e. is the speed that's causing a lot of the net volatility because it's causing funds to unwind positions in a more kind of risk manager, kind of forceful manner. If we can just have a gradual unwind of those positions and a falling dollar, that would actually support global liquidity through the lens of the cross-border financing channel. So in this chart, we just show the net international investment positions of all the major capital exporting economies in the world, with Japan, China, and Germany kind of all being up there at the top at around $3 trillion or a little bit over $3 trillion apiece. And so if we get a weak dollar, a sustained weak dollar, it's very likely that we actually see it would be a lot easier for these economies to create cross-border lending vis-a-vis in the euro dollar market and other forms and fashions that we typically see across the world. So that this would be a very supportive dynamic if it happens a lot slower than what we observed the past kind of 72 hours.
Now, I know that at 42 Macro, you guys have these two models. There's a grid model, and then you have this kind of weather model. Maybe you can give us an update on that. Like, what are you seeing with the grid model, and what is it telling us? Today's episode is brought to you by CrossFi. CrossFi is the Apple Pay for crypto. For the first time in history, anyone with a Web3 wallet like MetaMask can spend crypto through a physical or virtual Visa card anywhere in the world where Visa is accepted. No more exchanges or middlemen. Just link your wallet, get your card, and start spending today. CrossFi card transactions have already been successfully processed in New York, Los Angeles, London, Dubai, China, Japan, and over 20 other countries. Be one of the first to get your hands on a CrossFi card and a prize pool of up to $3 million by joining and participating in their testnet today. You can go to xfi.foundation/users. Again, that's xfi.foundation/users. Go check it out today.
Yeah, great question. So our grid model is just showing that the U.S. economy is likely to go into bottom-up macro regime deflation here in the third quarter. That's growth decelerating and inflation decelerating simultaneously. We're not overly concerned about that because, as you can see in the bottom left of the chart, we have our estimates for GDP growth are actually much higher than consensus estimates for GDP growth. So, and that's the case. That's likely to remain the case over the next 12-month forecast horizon. We've been consistently above ahead of consensus for the past roughly 3 quarters now with respect to U.S. growth, and we don't expect that to change over the medium term because again, we do our deep dive business cycle analysis. We come to the conclusion that there's very limited risk of a recession in the U.S. economy over the medium term. Now that could change if financial market change the wealth effect and cause business investment to slow, i.e., you have a negative wealth effect that kind of filters through the economy, but that's not our baseline expectation. Our baseline expectation is an economy that is slowing, but is likely to surprise consensus estimates to the upside throughout. We also have inflation slowing, kind of bottoming in Q4 before starting to meander higher in the first half of 2025. I do believe that's going to be a market risk for investors to have to deal with in 2025, but I don't think we have to price that in currently because we're still in a phase of accelerated shelter disinflation. When you go to slide 9 there, we show the grid model projections for not just the U.S. economy, but for all the economies in the world that we maintain grid models for. You go down, you look at the bottom, the world grid is actually different from the U.S. grid. So we have growth slowing in the U.S., but actually diverging globally, where you see that the world economy is likely to be in Goldilocks through year end, and then transitioning to kind of a reflation, later in the year. And then if you look at this on a mode basis, i.e. the highest frequency across all the economies in the model, the rest of the world is likely to remain in Goldilocks, which again is growth accelerating and inflation decelerating, which is obviously a very supportive backdrop for asset markets. That's the highest probability outcome for not just the world economy, but for the mode of all the economies in the sample right here. So that's a really positive supportive dynamic for liquidity as well.
Now, in the weather model, what is that telling us?
Yeah, so the weather model, so we use those 2 models to assess the probability of regime change in asset markets. The grid model gives us a medium to long-term time horizon look. That's anything between 3 and 12 months. And the weather model gives us a short to medium-term time horizon look into the probability of regime change in asset markets. And that's anything from 1 to 3 months in terms of our risk management nomenclature. And what we find right now in the weather model, we're seeing a neutral signal for the stock market and a neutral signal for Bitcoin, which, it tells you that investors should be expecting baseline type returns in those asset classes over the next 3 months. I'll give you, without going down, kind of each of these indicators, the things that are kind of contributing to a relatively sanguine outlook from a short to medium term time horizon perspective. An uptrend in global liquidity right now. That's probably the biggest factor there. We have rate cuts priced in terms of the 2-year nominal yield benchmark policy rate spread. We also have the unemployment rate is projected to decline from here over the next 12 months when you factor in consensus estimates. We also have other supportive dynamics as well. And so how this model works is what it's trying to do is nowcast current trends across all these principal components of macro, starting with the real economy cycles on the left and the financial economy cycles on the right. And each of those trends contributes independently to the rolling 3-month forward return projection that you're seeing for the various asset classes. And so, we're relatively sanguine here. We understand that the growth is slowing, so we're probably going to have defensive leadership in asset markets. When you think about this from a factor standpoint, the types of sectors and factors within the equity markets and credit markets that are likely to lead. But we're relatively sanguine on the actual beta of those asset classes from a medium to longer term perspective, because we just don't see the kind of economic risk here in the U.S. that would cause the Fed to slash rates much longer and sort of much deeper and much faster than what's currently priced in, which would obviously cause the unwind of the yield carry trade to accelerate in a more deleterious manner.
Now, you mentioned that you think that inflation is going to kind of continue to slow and then it will start meandering up. What is really driving that, especially kind of around the turn of the year?
Yeah, absolutely. So base effects are the primary driver of that. We're going to start to, kind of lap the easy compares, in inflation starting in Q1 of next year. And in our opinion, not in our opinion, according to our research, we've done a tremendous amount of work on understanding all the dynamics within the context of the business cycle. And the thing we found, one of the more important salient takeaways from our deep dive business cycle study is that inflation is the most lagging indicator of the business cycle. It typically only breaks down below trend 12 to 15 months after a recession has started. So without a recession projected to start, at least according to our forecast and according to how the current compendium of persistent leading indicators are aligned, since we don't see a recession, it's very likely that we just hit the bottom and start to cycle higher again in inflation, which has historically always happened. There's never been a business cycle in the history of the U.S. post-war U.S. economy that saw inflation return durably to trend in the absence of a recession. So we're not betting on that to be the first time here. It may happen. We may be wrong in that expectation, but we ultimately think that as long as we do avoid recession over this, kind of next 12-month forecast horizon, then it is very likely, based on how the business cycle has historically performed, that inflation will start to bottom and accelerate from a level that is inconsistent with the Fed's 2% target. But as you and I have talked about on the program, Pomp, we know the Fed doesn't want 2%. They probably want 3%. They're just pretending like they want 2% for credibility's sake.
How important is who wins the presidential election in November to all of this kind of economic analysis? Does it matter?
Oh, it's very important, in my opinion. So as you go back to that grid model, you see where we are most divergent from consensus with respect to our bottom-up macro regime projections up there in the top right, is that we are expecting a bottom-up macro regime inflation to persist for, kind of starting in a little bit in Q4, really not really. You won't notice it from a data standpoint, but you really start to notice it, in our opinion, once we get into the first half of 2025. And the reason we bring that up with respect to the election is if you think about the Kamala Harris winning the election, it's probably just more of the same from an economic agenda standpoint. Maybe there's, tinkers there, flip a lever here, flip a lever there. But the reality is we're probably going to see a lot more of the same with respect to Biden's industrial policy. The big difference, in our opinion, with respect to the economy is if we saw a new Donald Trump administration, because if you go back to the Republican National Congress or whatever they did last month, they outlined 2 day one policy initiatives by a new Trump presidency. And number one would be mass deportation, which would obviously be a negative supply shock to the labor market. Recall that immigration has been a positive supply shock to the labor market, allowing the labor market to grow in terms of total employment while also emitting a downward pressure on wages. That was obviously a really positive dynamic. And so if you reverse that, you're going to see a reversal of that in the economic statistics. And then number 2, in terms of the day one policy priorities for the Trump administration are tariffs, hiking tariffs, potentially broadly and very aggressively against China. So in our opinion, we already projected to have bottom-up macro regime deflation, really starting to hit the tape in the first half of next year, which is growth slowing and inflation accelerating. And obviously, if we saw a Trump 2.0 administration, then that would just exacerbate that with respect to the day one policy initiatives that they already outlined.
Now, everything that you're talking about, I think, is kind of directionally based on there not being any sort of catastrophic external, surprise, black swan, et cetera. One of the things that I found interesting is Wharton's Jeremy Siegel was on CNBC earlier this week, and he called for a 75 basis point emergency rate cut, and then another 75 basis point rate cut in September. Those emergency rate cuts, I mean, we did get them in 2020. I think we had 2 of them that brought us down to the 0% interest rate. What would have to be true for the Fed to cut rates in an emergency fashion before the September meeting, do you think?
Oh, that's a great question. So we would need to see a freezing up of the credit and repo markets, and that's obviously not been the case thus far, at least. So when we talk freezing up of the credit markets, that just means the market for primary credit issuance, companies borrowing money from investors, that market closes up like we saw in December of 2018. And we would likely need to see a freezing up of the repo market in the sense that you're seeing, very aggressive collateral haircuts. The, hypothecation in the repo market starts to contract, and we get less and less leverage being extended to borrowers in the repo market, which is what happened in the summer of 2019. We would have to see some type of dynamics, one or both of those dynamics would need to occur to cause the Fed to pivot. Recall that the Fed pivoted early January of 2019 after the Christmas blow up when the credit market froze up. The Fed pivoted in the summer of 2019 and started doing stealth QE after the repo market kind of seized up back then. And obviously, we saw emergency cuts and then very aggressive alphabet super monetary policy initiatives in March of 2020 with COVID. So there's a playbook for this. We're not expecting that kind of deterioration because ultimately we don't see the economic outlook as supportive of that. Now, we could be wrong because, again, what we're more concerned about right now, which is the thing that's harder to forecast, and I would argue it's probably impossible to forecast, is the endogenous risk, the market risk. We've been talking about this the whole time about exogenous risk. What's happening with policy? What's happening with growth? What's happening with inflation? Endogenous market risk is what's happening within the players of the market and how they are impacting each other. And so the thing that I'm most concerned about over the medium term as an investor is continued unwind of the carry trade in terms of risk managers at various firms, forcing investors out of positions, forcing portfolio managers out of positions. And that is the kind of thing that could feed on itself. We're not forecasting it to feed on itself, but nobody can credibly forecast that kind of a dynamic. And what that ultimately would result in is if Fund A blows up and has to unwind all of its positions, and it'll impact Fund B's positions, and then Fund B blows up and impacts Fund C, and so on and so forth. That is a legitimate material risk, and I don't want to mince words and sound overly Pollyannish and overly optimistic right now. We're cautiously optimistic right now because we understand that the exogenous market risks aren't nearly as onerous as they were kind of felt to be over this weekend. But we do believe that the endogenous market risk has not necessarily subsided. And until we get more quantitative confirmation vis-a-vis our risk management signals, then I think investors should be proceeding with caution until we get those kind of all clear signals in the coming days and weeks.
Darius, you now are a dad, and some people, they become a dad and they lose their kind of sharp edge. They start to degrade away. That didn't happen to you. I think you've gotten better since you became a dad. So I appreciate you coming on and kind of walking us through this. I think there's a lot of people saying, hey, there's this chaos, this uncertainty that's kind of playing out, trying to wrap their head around it. Where can we send people to find information at 42 Macro if they want to subscribe there?
Look, I appreciate you, man. You've been a wonderful role model as a father. So I just want to say thank you for all that you've shown me and taught me over the past few years. Obviously, investors that want to have the opportunity to invest with confidence and clarity in these volatile times. That's exactly what we do for our clients here at 42 Macro. So definitely come check us out. Obviously, we have an institutional feel to our research in terms of our core client base. But obviously, we have thousands of retail investor clients around the world that are benefiting from our clear and actionable signals as well. So we appreciate everyone for joining us, and come check us out, 42macro.com.
Amazing. We'll definitely do this again next month. So I appreciate the time and hope everyone learned something today.
I appreciate you, Bob, and thank you very much.